After studying this module, you shall be able to know the importance of rational decision making, learn the various principles that assist the manager in making a rational and objective decision.
Economic decision making is one of the most challenging tasks for a firm. The manager or producer, given the constraints of scarce resources and the factors operating in the economic, political, and legal environment, has to undertake such decisions. Given the various constraints, it is a task for the manager to take such decisions that can help an organization to achieve its objectives. It is quite difficult for a manager to undertake a large number of decisions. In this module, we shall be considering how a manager undertakes such decisions with effectiveness and efficiency. So, we shall be dwelling upon various principles that assist a manager in undertaking such rational economic decision making. Managerial economics is a synthesis of principles and practices of management. It involves both the principles of economics as well as the principles of management. It also involves both concepts and methods of measurement because management is a practical science. Before we examine the practical aspects of economics from the point of view of management, we need to understand the basic principles of managerial economics. Therefore, it would be useful to identify and understand some of the basic concepts underlying the subject matter of managerial economics. Economic theory provides the basic tools of analysis which can be of great help to a manager in decision making and in business planning. While in the real world there may be many different principles and there may be differences between the principles and what obtains in the real world for solving the actual problems, it is still necessary for a manager to understand the principles for realizing where the real world differs from these principles and what has to be done in this respect. Any theory that attempts to explain the real world, but at the same time it has to be an abstraction. So, it has to draw away from reality for having a better, simpler, and more elegant solution to the real world economics, and hence the problem solving which is necessary for management of the firm, management of a business, involves a mixture of the basic principles which are pure theory with the practice that a manager has to develop and understand. Therefore, it is necessary to examine these basic principles of managerial economics. Through this, we can arrive at the nature of economic theory of the firm and how it helps management in decision making. The basic principles of economics can be stated as the following. The incremental concept or the the marginal principle, the concept of time perspective, the opportunity cost concept, the discounting concept, the equi-marginal concept, and the concept of risk and uncertainty.
The individual manager or consumer undertakes certain decisions which relate them to the market. This is done with the help of certain principles. Managerial economic principles do not offer any ready made solutions to the problems faced by managers in the changing business world. These principles only assist managers in rational reasoning and defined thinking by developing logical ability. These economic concepts and principles are fundamental to business analysis and decision making. Let us discuss each of these in detail. Incremental principle. The most fundamental principle in economics is the incremental concept. It is the most frequently used principle in managerial economics. This is also known as the marginal principle. There are three situations in which the marginal principle is used: production decision, consumption decision, and technological decision. Production decision. Incremental concept involves estimating the impact of the decision on the alternatives on costs and revenues of the firm generated as a result of that decision. Incremental cost is defined as the change in total cost resulting from a particular decision. Incremental revenue is defined as the change in total revenue resulting from a particular decision. In the production decision, two things are compared at the margin: marginal cost, that is, the increase in total cost due to a unit increase in production, and marginal revenue, that is, the increase in the total revenue due to a unit increase in production. Each producer is faced with this decision, that is, how to decide when to increase production and when to decrease. If the optimal plan is not achieved, then either the producer may incur a notional loss, that is, less than maximum profit, or he may incur an actual loss. The former happens when marginal revenue is above marginal cost. The latter happens when marginal cost is above marginal revenue. The marginal principle involves a comparison of benefit with cost at the margin, that is, comparison of incremental revenue with incremental cost. Incremental cost denotes change in total cost, whereas incremental revenue means change in total revenue resulting from a unit increase in production. As each unit of production increases, two things happen: the total cost of production increases, and simultaneously, the total revenue from the sale of production also increases. The former is known as marginal cost, and the latter is known as marginal revenue. The incremental principle may be stated as follows: a decision is clearly a profitable one if at the margin: 1. Upon the increase in production, marginal revenue remains constant or falls, and marginal cost rises such that marginal revenue remains above marginal cost and total profit rises. 2. Upon the decrease in production, marginal revenue remains constant or rises, and marginal cost falls such that marginal cost remains above marginal revenue but total profit rises. 3. Upon decrease or increase in production, total profit falls. Production can be increased only on the basis of incremental reasoning. Incremental reasoning does not mean that the firm should not invariably increase production at all prices. It is the relationship between incremental costs and incremental revenue that determines the course of action, that is, to increase or decrease production. Following the marginal principle has the advantage that it does not require a direct calculation of profit at each point or while considering each production plan. The concept is mainly used by the progressive concerns. Even though it is a widely followed concept, it has certain limitations. A. The concept cannot be generalized because observed behavior of the firm is always variable. B. The concept can be applied only when there is excess capacity in the concern. C. The concept is applicable only during a short period. If a firm decides to increase production, then the additional revenue it earns by selling one additional unit of the product will be termed as marginal revenue, and the extra cost of producing the additional unit is called marginal cost. Thus, when the incremental revenue exceeds incremental cost, the decision to produce an additional unit will be regarded as profitable. Thus, the marginal principle helps a producer decide whether to continue further production or stop. Consumption decision. Similarly, if a consumer wants to decide how much to buy, he or she will receive an additional utility from one additional unit of consumption called marginal utility. The cost of obtaining one such additional unit is the price, which is normally the average revenue AR. This is usually equal to the marginal revenue MR under competitive conditions. Thus, the marginal utility exceeds price, then the consumer is encouraged to consume more of the commodity. On the other hand, if on increasing consumption the marginal utility falls and becomes less than the price or average revenue, then the consumer is discouraged from buying more. Only when the marginal utility from consuming one additional unit equals the price or AR does the consumer stop increasing consumption. At this point, the consumer obtains maximum utility. So there is no advantage in either reducing consumption nor is there any advantage in increasing consumption. This is how the marginal principle helps the consumer. Technological decision. Each producer has to employ different factors of production like labor and capital. There is a choice that the producer faces. He could either use more of labor and less of capital or the other way around. While employing one more unit of labor, there are two outcomes. The production increases by a certain amount, known as marginal productivity of labor. The cost of employing one more unit of labor is the additional wage. This is known as marginal wage and is often equal to average wage under competitive labor market conditions. If employment increases, the marginal productivity falls, and usually the marginal wage rises. As long as the marginal productivity is greater than marginal or average wage, it pays for the producer to engage more units of labor. But if the employment goes beyond a limit, then the marginal productivity may go below the marginal or average wage, and it may lead to a loss to the producer. At the margin, a producer would decide to stop employing more of labor as soon as marginal productivity and marginal wage become equal to each other.
Let us now discuss the discounting principle. It is one of the most fundamental principles that state that the worth of a rupee tomorrow will be less than what it is worth today. Money actually has time value. Thus, 1 rupee held today does not have the same value as a rupee held tomorrow. The household that has generated this savings, which is invested in any investment project, would like to be compensated for the postponement of their consumption. This is because they prefer consuming today, and therefore savings which are basically obtained from households by the households undertaking some kind of tightening of the belt, in fact pinch the household, because it means that they have to forego consumption today. Their preference is for consumption today rather than in the future. Therefore, there is a premium on present consumption over future consumption. The discounting principle implies that any future value that is obtained from an investment is a long term investment project as a cash flow cannot be treated as being equal to its present value. Any investment project needs investment, which in turn is obtained from savings, and these savings are provided by the household. Firms invest and households save. In anticipation of getting a return on their savings, households expect a higher value in the future, which will compensate them for the consumption that has been foregone in the present. Without foregoing consumption, savings cannot be generated. The return that households should get from such an act of savings is to be at least sufficient to compensate them for the postponement of consumption. Therefore, the rate at which households prefer present consumption over future consumption is a measure of the premium that exists on present consumption. Any future value, that is a cash flow, which is generated through any long term investment project, needs to be adjusted for this premium. The rate at which this adjustment is done is known as the discount rate. It is known as the discount rate and not the rate of interest because it is actually involved in reducing or deflating a value which occurs as a cash flow in the future. Also, another important fact is that from the point of view of investment, money that is held in the hand today could be invested and it could lead to some kind of receipt and it would lead to a greater money value in the future.
An amount to be received at some future date could not be invested until it is received. For instance, rupees 1000 invested today at 10% interest is equivalent to rupees 1100 next year. This phenomenon is known as time value of money. Discounting, therefore, can be defined as a process used to convert future value into an equivalent present value. That is, the principle states that if a decision affects costs and revenues in the long run, then all such costs and revenues must be discounted to present values, and then only a valid comparison of alternatives is feasible. The discount rate is the obverse of the interest rate. Ordinarily, we are familiar with the compounding process. Fv is equal to Pv multiplied by 1 plus r raised to the power t, where Fv is the future value at some future time, Pv is the present value at time 0, r is the interest rate, and t is the time between the future value and the present value. In this case, the present value is lower, but it grows over time. Hence, we use interest rate which makes the present value grow over time. But when we consider discounting, the opposite happens. A future value needs to be reduced and brought in line with the present value, which is lower. Therefore, the relevant economic calculation is that future value or future cash flow needs to be discounted. Thus, PV0 is equal to FVI divided by 1 plus R raised to the power t. FVI is equal to future cash flow in the ith year. PV0 is equal to present value of future cash flow. This principle equally applies to consumers who have the choice to consume today or not consume today and save for tomorrow. Therefore, there are two rates of discount: one, investment rate of discount, and two, the consumption rate of discount. Let us now move on to the next principle, that is, equi-marginal principle. Marginal utility is defined as the utility derived from the consumption of an additional unit of a commodity. A consumer has unlimited needs and wants, and therefore he consumes or avails a variety of products and services. The law of equi-marginal utility states that the consumer reaches the stage of equilibrium when the marginal utility of various commodities consumed by him are equal. It states that the consumer will spend his money income on different goods and services in such a way that the marginal utility of each good is proportional to its price. That is, MUX by PX is equal to MUY by PY is equal to MUZ by PZ, where MU represents marginal utility and P is the price of the good. If the consumer finds that the utility is greater in case of a particular commodity as compared to another, then the consumer must realize the fact that an optimum or equilibrium level has not been achieved.
The opportunity cost concept. Now, this is another principle. In everyday life, we apply the notion of opportunity cost even if we are unable to articulate its significance. In managerial economics, the opportunity cost concept is useful in decision making. It involves a choice. Opportunity cost is all about making a choice between different courses of action. Resources are scarce, and therefore the producer cannot produce all commodities. For the production of one commodity, we have to forego the production of another commodity. We cannot have everything that we want. We are therefore forced to make a choice. The opportunity cost of a decision, like a production decision, is the sacrifice of an alternative required by that decision. That is, because all decisions cannot be undertaken simultaneously, we choose one particular alternative and in the process have to sacrifice another alternative. The sacrifice of the alternative involved happens while carrying out some such decision, and it requires that resources which are limited in supply are diverted from one alternative to the other. So, what happens is that there is an opportunity cost, that is the cost that is associated with the alternative or the opportunity which has been missed in lieu of the opportunity or the alternative which has been chosen. Thus, the opportunity cost represents the benefits or the revenue foregone by pursuing one course of action rather than another. The concept of opportunity cost implies three things. The calculation of the opportunity cost involves the measurement of sacrifice. Sacrifice may be monetary or it may be real. The opportunity cost is termed as the cost of the sacrificed alternative. Opportunity cost, therefore, is a notional idea which does not appear in the books of accounts of the company. If the resource had no alternative use, then obviously there is no opportunity cost. The opportunity cost is nil. In managerial decision making, the concept of opportunity cost occupies an important place. The economic significance of opportunity cost is as follows. It helps in determining the relative price of different goods. It helps in determining the normal remuneration to a factor of production, and it helps in the proper allocation of resources. Slide 42. Let us now recapitulate what we have learnt in this module. In this module, we have discussed that the most important task of a manager is decision making. A manager is faced with various constraints, and thus it becomes crucial for the manager to undertake decisions which enable the firm to attain the objectives effectively. In such a decision making process, the managers rely on certain fundamental principles. These principles are economic principles, and they guide the manager to make a sound decision, to undertake a sound decision. The incremental principle emphasizes that the manager should consider the incremental cost and revenue that the firm would incur as a result of that decision. This implies that the decision rests upon what happens when the production is increased by 1 unit. Both sides, that is the side of cost and the side of revenue, have to be considered simultaneously, and there has to be some kind of equivalence between the marginal cost and the marginal revenue. The incremental principle emphasizes that the manager should consider the benefits and costs. The discounting principle emphasizes that the fundamental concept of time value of money is important, and therefore the expected costs and revenues that a firm will incur or generate in the future should be discounted so that the entire economic calculations are done only in present value terms. Unless this is done, it is not feasible to evaluate different alternatives. As has been said earlier, economics is a science, and so is management a science, a question of different alternatives and choices. Similarly, there could be a consumption rate of discount that a consumer faces, that is, that a consumer has to evaluate the rate at which he or she prefers present consumption over the future consumption. So, this is based on the consumption foregone today. The discounting principle implies that any future value that obtains from an investment in the long term has to be calculated in terms of the cash flows, and these cash flows have to be equated to the present value. Any investment project needs to be evaluated in terms of the obtained savings from the households and how these savings are being invested, and finally as to what is the present value of the cash flows that occur in the future from this particular investment project. Equi-marginal principle states that the consumer spends the money on a basket of goods and services and spends the money on different goods in such a way that the marginal utility of each good is proportional to its price. So, the concept of opportunity cost of a decision is the sacrifice of that is involved in alternative uh, options that a manager faces, and the sacrifice of one alternative involves a cost in when the choice is made in favor of another opportunity. Now, all opportunities cannot be pursued at the same time because resources are limited. Hence, opportunity cost represents the benefit or revenue foregone by pursuing one course of action rather than another. The time perspective concept states that the decision maker must give due consideration to both the short run and the long run implications of his decisions. Managerial economists are also concerned about the short run and long run, and in such circumstances they have to consider both the revenue as well as the cost. Finally, there is the concept of risk and uncertainty. This is very important for managerial decisions, and it involves certain economic values. Therefore, it is one of the important principles, the economic principles underlying managerial economics. For a certain institution to undertake such decisions which are to be undertaken in an environment where there is risk and uncertainty, where all the information about production, market prices, and utility and profits and so on are uncertain. Under such circumstances, decision making becomes very complex. Under the conditions of uncertainty, the consequences of different actions are not known for sure. There is no definite value which can be placed on the entire economic calculations, such as the cost and the revenue and prices and so on. Now, this becomes a challenge because undertaking such decisions under such conditions becomes very difficult for a manager.
Let us now discuss the concept of time perspective. The time perspective concept states that the decision maker must give due consideration both to the short run and long run effects of his decisions. He must give due emphasis to the various time periods. It was Marshall who introduced the time element in economic theory. The economic concepts of the long run and the short run have become part of everyday language. Managerial economists are also concerned with the short run and long run effects of decisions on revenues as well as costs. The main problem in decision making is to establish the right balance between the long run and short run. In the short period, the firm can change its output without changing its size. In the long period, the firm can change its output by changing its size. In the short period, the output of the industry is fixed because firms cannot change their size of operation and they can only vary the variable factors. In the long period, the output of the industry is likely to be more because the firms have enough time to increase their size and also use both variable and fixed factors. In the short period, the average cost of a firm may be either more or less than its average revenue. Let us now discuss the concept of risk and uncertainty. Managerial decisions are actions of today which bear fruit in the future which is unforeseen. Future is uncertain and involves risk. The uncertainty is due to unpredictable changes in the business cycle, structure of the economy, and government policies. This means that the management must assume the risk of making decisions for their institution in uncertain and unknown economic conditions in the future. Firms may be uncertain about production, market prices, strategies of rivals, etc. Under uncertainty, the consequences of an action are not known immediately for certain. Economic theory generally assumes that the firm has perfect knowledge of its costs and demand relationships and of its environment. Uncertainty is not allowed to affect the decisions. Uncertainty arises because producers simply cannot foresee the dynamic changes in the economy and hence cost and revenue data of their firms with reasonable accuracy. Dynamic changes are external to the firm, they are beyond the control of the firm. The result is that the risks from unexpected changes in a firm's cost and revenue data cannot be estimated, and therefore the risks from such changes cannot be insured. But producers must attempt to predict the future cost and revenue data of their firms and determine the output and price policies. Managerial economists have tried to take account of uncertainty with the help of subjective probability. The probabilistic treatment of uncertainty requires the formulation of definite subjective expectations about cost, revenue, and the environment. The probabilities of future events are influenced by the time horizon, the risk attitude, and the rate of change of the environment.